Okay, so this video covers introduction to journal entries and how the accounting equation applies to them. So to start off with, we're going to look at the equation itself. So the accounting equation is simply assets equals owner's equity plus liabilities. So what we're going to do is we're just going to have a look at a quick example just to see how this actually works in the real world. So we have an example here where we can see we have a car worth $1,000. We have some share capital of $200 and a car loan of $800. So essentially what this picture shows is, a business will have bought a car for $1,000, and so that's their asset. And someone would have put $200 into the business to actually fund the car. So that's $200 of the business's own money, which is your owner's equity. And then they would have also taken out a car loan of $800, which is a liability to actually finance that car. So you've got your car being your asset, your $200 share capital, which is what the money the owners put in, and then also the $800 liability, which is the loan taken out to fund that car. So this is an equation, and so the equation must always balance. So another thing to note, which is important, is the equation governs the balance sheet. So if we have a look at a standard balance sheet here, you can see we have assets on the left and liabilities and owner's equity on the right. So we've got our equation back here, assets equals owner's equity plus liabilities. If we look at assets, the total of assets is $8,374. If we look on the right, liabilities is $4,171. If we add the total of owner's equity being $4,203, we get a total of $8,374. So our assets on the left equal the sum of liabilities and owner's equities on the right. So the question is here now, how do accountants manipulate the accounting equation? And the answer is journal entries. So whenever we do a journal entry, we're actually putting an entry into the general ledger, and that general ledger is used to build your balance sheet and your profit and loss statements and your other financial statements. So that's an important thing to note. When you're doing your journal entries, you're sort of directly impacting your balance sheet, your profit and loss statement, those important statements. So if we have a look at just a very simple journal entry here, we're just going to go over some of the features. So the first one is the date. We always have the date when we do a journal entry. So we usually put that on the left. And then we have this debit and credit, okay, which is usually what scares people. And so DR here equals debit and CR equals credit. I've just noted that in the right-hand side. And then what we have is usually the account name that you're manipulating or changing, or an explanation. So for example, here I've put asset, but you'd normally do debit cash or debit car, or debit revenue, something, the actual account name, or something explaining what you're actually changing the value of. And then finally, we have the actual dollar amount. So some important things to remember about journal entries generally. Each journal entry must have a debit and a corresponding credit. So you can see here we've got a debit and a credit. You can never just have a debit by itself or a credit by itself. If you have a debit, there must be a credit. Okay, and you can have multiple debits and credits as well within sort of one entry, but the total values must always balance off. And what I mean by that is you can see here the debits in this entry add up to $100 and the credits equal $100. So if I did the debits minus the credits, so 100 minus 100, it would equal 0. So the total values of your debits and the total values of your credits must always be the same within your entry. That's really important because we want to make sure that the accounting equation is always balanced. And the final point is a journal entry can include any combination of assets, liabilities, or owner's equity. So for example, here I've got debit asset and credit asset, but it could be debit liabilities and credit owner's equity, or debit asset and credit liability, or debit owner's equity and credit assets. Okay, so that can be any combination. So here's a really important question now. How do we work out if we need to debit or credit something? And it's always something which confuses people quite a lot. So we're going to go through it now. So we're going to start off with assets. So to increase the value of an asset, you must debit something. So if somebody gives you $1,000 of cash, you now have an extra $1,000 of cash. So you debit cash $1,000, and so that increases the value of cash on your balance sheet because you physically received more and it increases the value. If I gave $1,000 cash to somebody else, that means I'd have $1,000 less cash. I've gotten rid of it. That means I'd need to reduce the value of cash on my balance sheet and I would credit it. Okay, so that's assets. Debit to increase, credit to decrease. Now we move on to owner's equity. So to increase owner's equity, I credit. Okay, so let's say I've issued some share capital, okay, to a new person who now owns part of my company, right? I issue them $500 of share capital. They now have an interest in my business, or some owner equity in my business, so I would credit $500 of share capital. And then the opposite with owner's equity, let's say I bought out somebody else, I bought their share of the business, they would no longer have a share of a business, so I would debit their share, their interest, what they own, to reduce that value to zero because I've bought it out and they no longer have any. Okay, and then if we move on to liabilities, again, credit to increase and debit to decrease. So let's say with a liability, I took out a bank loan. Okay, so the bank gave me $1,000 cash. All right, so I would need to recognize that liability on my balance sheet. So I would credit $1,000 to my bank loan. Obviously, you would debit cash as well because the bank's given you $1,000, but in terms of liabilities, we'd recognize that $1,000 with a credit. Now, just some things to point out here. Owner's equity and liabilities, they're exactly the same in terms of their credits and debits when you're talking about increasing or decreasing. So owner's equity and liabilities, you credit to increase and debit to decrease. So I guess one way that you can try and remember these things is I always say to increase the value of something on the left of the equation, which is assets, we need to debit, and to increase the value of something on the right of the equation, so owner's equity or liabilities, we credit. So if you remember those two things, then you can work out the opposites because, if you increase something to credit, the opposite is you decrease something by debiting. So if you just remember assets on the left of the equation, I debit to increase, and then anything on the right of the equation, I credit to increase, you can easily work out the opposites when you need to. So I've just got a basic example to go through now, just to finish things up. So I've put our equation here with our sort of denotions of which debits and credits we need to do, and it's a good idea to often copy this down and have it with you when you first start off so you can refer to it to make sure you're getting things right and you can visualize things. So we've got here, John buys a car for $1,500 and paid cash on 21 June 2021. So record the journal entry for this transaction. So first thing here, 21 June is my date, and we're dealing with the car first. So I bought a car, I got an asset, I now own it, okay? So we need to reflect that increase in value on our balance sheet. So to do that, we're going to debit. Okay, we're going to debit our car, debiting our asset, we now own it. Okay, so we debit car for $1,500. Now we paid cash, we physically gave it away to somebody else, we no longer have it, so we need to reduce the value of cash on our balance sheet, so we're going to credit, okay, because cash is an asset, we're going to credit, we're going to reduce that value of cash because we physically gave it away. And that's it, that's a nice simple example that we've gone through, okay. And now I'm just going to take you through a very quick summary of what we've talked about. So I think the most important thing is this chart down here. Make sure you have it, copy it down so you can refer to it. Eventually you'll be able to remember these things, okay? But it's good to have it there to refer to when you need it. So basically what we've talked about, accounting equation, assets equals owner's equity plus liabilities. Okay, the accounting equation governs the balance sheet, and whenever we actually do a journal entry, okay, we're manipulating the equation, we're essentially putting an entry into our general ledger, and those journal entries are then used to build our balance sheet, our profit and loss statement. So that's really important. When we're doing a journal entry, we must always have a debit and a corresponding credit. Okay, we can never have a debit or a credit by itself. They must be paired. And the total value of our debits must also equal the total value of our credits. And that's it. Thank you.